Yeah, don't worry about the straight line. I will do a question that has got that thing. Yeah. We'll do a question that has got the question that is on the depreciation as well. Don't worry. So this is the assignment number 1 that you had, and this was the question. This was the question. So you are given the trial balance, and this is the trial balance that you had. Then from the trial balance down, you had the additional information that you were provided. And from the additional information, you needed to make some adjustment to some of the entries in the trial balance. That is what you were just required of doing. So the first thing that we are going to do, as usual, is to read the question as we have seen. So we need first to start by reading the question. And after reading the question, you check the elements that are there in the trial balance and be able to allocate them. Identify the elements that go in the tradings account, those that go in the profit and loss, and the elements that go in the balance sheet. Once you identify the elements, then it means that you are good to go. You can actually start solving the question. So after you've checked the elements that are there in the trial balance, it's very important that before you even start answering, you check the adjustment that you have to make. Okay. So when you look at the adjustments that you have or the additional information, you concentrate, number 1, especially on the closing stock, opening stock, and the adjustment on the allowance for receivables. The adjustment, this is adjustment number 6, the allowance for receivables. Sometimes in other literature, it is called the provision for doubtful debt, okay? Why should you consider this one first? It's because if it is a reduction in the allowance for receivable, you have to add it in the tradings account. So you find that if sometimes you just go straight by solving without looking at that, then when you look at the information, the additional information, you find that there was a reduction in the allowance for receivables that will affect your trial balance. So it is very important that you just do that. So the first thing that you are doing is to identify these elements that are given here and just allocate them according to the positions in which they are going, where you're going to record them. I'll say we have got the tradings account, the profit and loss, and the balance sheet. So just check where they are going. Since we are revising, we all know where these are going. I'll be just asking the question, then quickly you answer. Where does advertising go? Is it in the profit or loss account or in the balance sheet? Hello?
Profit.
Okay, so this one goes in the profit and loss account. Then you go to the bank. The bank is an asset, all right? Where do you place asset? Anyone?
Balance sheet.
Okay, it goes in the balance sheet, BS. Then the bank loan. The bank loan is a liability, long-term liability. Where do the long-term liabilities go?
Balance sheet.
They go in the balance sheet, BS. Then you got the bank interest. The bank interest is an expense. Where do we record the expenses? Anybody?
Profit and loss.
Okay. Yeah, we can all participate, and otherwise, it goes in the profit and loss account. Then you go to the capital account. The capital account, capital. Sorry, not the capital account. The capital. Where do you place capital?
Balance sheet.
Capital is equity. It goes in the balance sheet, BS. And the capital introduced, obviously, it goes in the same direction. Then carriage outward. Where do you place carriage outward?
Profit and loss.
Okay, Carriage outward goes in the profit and loss account under expenses. So carriage outward is treated as an expense. Then computing expense, those are expenses. All expenses go in the profit and loss account. Then you got the payables. The payables sometimes are called the creditors. Where do you place the payables? The creditors. It's a liability, this one, a short-term liability.
Balance sheet.
It goes in the balance sheet, right? The short-term liabilities are placed in the balance sheet. Receivables, sometimes you call them the debtors, okay? In other literature, you find them recorded as the debtors. So receivables account or debtors, they go into the what? Into the balance sheet as current assets. They go as what? As current assets. Discount received. Discount received. You can have discount allowed and discount received. You have received some discount. Where does this one go? Where do you place the discount received?
Profit and loss.
Okay, it goes in the PL, right? In the profit and loss account. Then you go to the drawings. Where do you place the drawings, eh? You withdraw money for personal use. Where do you place this one?
Balance sheet.
The drawings go in the BS, the balance sheet. You have power, which is an expense. Power is an expense, it goes in the profit and loss account, right? We said all expenses, they go in the profit and loss account. Then we go to allowance for receivables. Okay. The opening allowance for receivables. This one is an allowance for receivable that was there from, you got it from the previous period. Remember the period that is under consideration is that one from January, 1st January up to the 1st December. Okay, from 1st January up to the 1st December. Okay, so this allowance for receivable brought down is basically the allowance for receivable that you got from the previous period. So where do you consider this one? Where does it go? Is it in the balance sheet where you consider this one or in the profit and loss account? Anybody? They brought down allowance for receivables. Okay, so the allowance for receivables is considered, yes, sir. We can hear you.
Yeah, it can be considered in the profit and loss, and then at the same time, it can be considered, I think, in the other incomes.
Okay, so this one is considered both in the profit and loss account and in the what? In the what? Where do you consider allowance for receivables? It will be factored in the balance as well, as we are going to see. Yeah, we'll show how to factor in. It doesn't mean you're recording this entire amount. You will see when you start solving the question. Then you got the sales. The sales go in the trading.
You skipped something.
Which one is that? Oh, fixtures. Or fixtures, those are assets, okay? The assets, they go in the balance sheet. Thank you. The fixtures go in, those are fixed assets, okay? They go in the balance sheet. The sales go in the tradings account, that is in the profit and loss account. Then the purchases as well, they go in the profit and loss account. Rent and salaries are what? Are expenses. We said that all expenses, they go in the what? In the profit and loss account. Accumulated depreciation on fixtures, okay? The accumulated depreciation on fixtures. Where do you consider the accumulated depreciation? Is it in the balance sheet or in the profit and loss account?
Balance sheet.
Okay, in the balance sheet, that's where you consider both the
balance
accumulated
sheet.
depreciation and the depreciation that has occurred in the period under concern. Then you have some inventory here. This one is basically the opening inventory. The inventory at 1st January 2021. So the opening inventory is considered in the profit and loss account. Is that clear? Hello.
Yes, it's clear.
Yes, sir, it's clear.
Okay. If that is clear, then let's see now the few of the adjustments that we have to make. Few of the adjustments that we have to make, and let's consider them. Number one, we have the inventory at the 1st December, which is basically the closing inventory. Okay, this first adjustment. The closing inventory go where? Is it in the balance sheet or the profit or loss account? Closing inventory.
Profit and loss.
Profit and loss.
It goes in the profit and loss account. Then you go to the prepayment for rent. Now, listen clearly now, so that you see how we do the adjustment, so that when I start explaining the solution, you are understanding. We have identified where all these elements go. Check now the following adjustments. Number one, the prepayment for rent. There is a prepayment for rent, 4,000. So what this means is that you paid for rent in advance. Okay, so the prepayments are always subtracted from those expenses under concern. Let's say you have got rent. Your rent here is worth how much? It's 12,000. Yeah? So from 12,000, you will subtract the prepayment of that rent. So you had to pay in advance a 4,000. So say 12,000 minus 4,000. That should give you 8,000. Okay, so it means that when you are recording the expenses when you're recording rent, you record 8,000, not 12,000. Okay, why not recording 12,000? Is because you paid in advance. A prepayment simply means you had to pay in advance this amount, but as well paying in advance, you just paid a 4,000, but your total bill is the 12,000. So you subtract first what you paid for in advance. Is that clear?
Yes, sir, it's clear.
Anyone to ask questions? If you're not clear, you need to understand the adjustment so that when we go through the solution, you are just moving fast. The learning part is here. This is where you have to learn from. So prepayments are what? Are subtracted. Always you subtract the payments. So when you go, you know that we have said that rent goes under expenses, right? So when you go under expenses, when you write rent, you will not write 12,000. You write 8,000 because you would have subtracted a prepayment. Is that clear?
Yes,
Yes,
sir.
sir.
It's clear, sir.
Okay. If it is, okay. Is Ruth in the meeting, right? Sorry. I'm just trying to find out.
Let me check on her.
Just a minute. Is Ruth in the meeting?
No.
She's not.
She was asking whether the link is correct or not.
No, the link is very correct.
Okay.
Very much correct.
Okay, let me call her, so she'll join soon. Let me
No,
just call her.
I've already sent her the link. I'm sure she's seen it on WhatsApp, so she'll be able to join soon. She should be able to join.
Thank you, sir.
Okay. Okay. Progress. So now, when you go to adjustment number 3, accrue for power. Okay, these are accrues for expenses or accrue for expenses. What do we do to accrues for expenses? Since this is a revision, I don't need to speak so much.
We add.
Okay, so
Those
the
you add.
okay, for accrual expenses are added. You have to do what? To add them. So for example, here, just a minute. All right. So the accrue for expenses, you have power. Eh? Power is an expense. So they're saying there is an accrue for power with 2,000. Okay. So it means that when you are recording power under expenses, you will not just record how much is power. How much is power on the trial balance?
8,000.
8,000.
Okay, 8,000. So you will not record 8,000. Instead, you're going to record what? You're going to record the
10,000.
10,000. Okay, 8,000 plus what? Plus 10. Plus 10,000 plus 2,000. Sorry. So in short, you have heard what I'm talking about. So you record what? 10,000 under power. That's what you're going to do. Clear?
Clear,
Yes,
sir.
sir.
Yes, sir.
Okay. Is Ruth in now?
She said she's trying.
Oh,
She's trying
she's
to
trying.
join just now.
She's saying that the PC is slow to load. She's trying to use PC that's slow to load. Anyways, she will join. The good part is that the class is being recorded. And let's go to adjustment number 4. The computer crashed in December. Remember, December 2021, this is when we're closing this financial year. So an engineer gave an estimate of 1,000 to repair the computer, while this guy accepted. So the engineer repaired the computer in December, but has not yet submitted the what? The invoice. So, which means that they have not yet paid for what? For this for the repairing of this computer, but this computer has already been repaired. So how do you regard this 1,000? Anybody?
We add it to 20,000.
The bottom figure?
Okay. So since it's an expense for computer, you go to a computing expenses, right? Have you seen the computing expenses? They are here, 20,000 computing expenses. So you say 20,000 plus what? Plus that 1,000, okay? It's more like an accrue. It's an accrue. It's an accrue for expenses, right? For computing expenses. Therefore, you record 21,000. Is that clear?
Yes, sir.
Okay. If that is clear, then we can go to just follow the adjustment that we are making. We'll show you the solution. Don't worry, we'll do the solution together. We are still discussing the question. And that is what you are supposed to do. First, you have to discuss the question with yourself. Understand the question, understand a few adjustments that you are supposed to make before you can progress into what? Into attempting the question. Number 5, depreciation of 30,000 is to be provided for the year ended 31st what? December on the fixtures. Okay. So it means that there is what? there is a depreciation for fixtures here. This depreciation, remember that now, it's not an accumulated depreciation. Check, there is this accumulated depreciation that you had on first January, when you just opened the financial, you had this depreciation. Or the fixtures, which are fixed assets, they had already depreciated by what? By 30,000. So now we are trying to say that, we are trying to say that now, from again 1st January up to 31 December, which is the period under constraint that we are trying to consider. Again, these fixtures, they lost the value of 30,000. So this one is the depreciation that you are going to record in the profit and loss account. Is that clear? Remember, under expenses, that's where you record depreciation. Depreciation is regarded as an expense, which is just the wear out of value of a fixed asset. When a fixed asset loses value, then you record that as a depreciation under expenses. Now, the point that I should be quick to underscore is that the only depreciation that you should include in the profit and loss account is the depreciation that has occurred only under the period of consideration. So the period of consideration is from January up to December 2021. So we are just interested in the depreciation that occurred in that period. We are not, at this point, we are not interested about that accumulated depreciation, which we opened with, okay, this one. This depreciation occurred in the previous period. So we are not interested in it at this point. Is that clear?
Yes, sir.
Yes, sir.
Yes, sir, it's clear.
If that is clear,
Very clear.
if that is clear, adjustment number 6.
Allowance
Adjustment number 6.
receivables,
Allowance for receivables. In some little,
5%.
now, here is the point that you should get. Understand that I'm also giving you the other words. You don't have to be used of just same words, because the lecturer may use different words, but they mean the same thing, right? Allowance for receivables are still treated as the provision for bad debt. Provision for what?
Bad debt.
For bad
Bad
debt.
debt.
For bad debt.
Ew.
For bad debt. Yeah. So provision for bad debt
Giver.
is treated as the same as the allowance for receivables. Now listen, what is there is we are given a guidance here that the provision for bad debt or the allowance for receivables is just 5% of the receivables on a straight line method. Okay, it's just 5% of the receivables. Where is this one? I'm muting.
Who is asking for Manzi? Mute your mic.
Wazulu.
Wazulu, your mic is on and this class is being recorded. It's not a very good thing where the entire world listens that you're asking for water, because these videos are posted on the media to be watched by other people in the world. So it's not a very, very, very interesting thing. Okay, away from that, we continue. We continue. Progress. So I was saying that the allowance for, yes, madam.
Before we proceed, I think I tried to take you back. I just wanted to find out under this accumulated depreciation on fixtures at 1st January 2021, we are not interested to this factor at this point. However, we are just interested that with this 30,000 for, is it December? Or is it? Yeah. To be provided for the year ended 31st December. Maybe explain, just explain for me there. I think I'm a bit behind.
Okay, thank you. The accumulated depreciation on 1st January, it means that this is the loss of value of this fixed asset that occurred in the previous period. Remember, you have opened the financial year in on 1st January 2021. Now you are looking for the profit and loss account as at 31st December 2021. So you want to assess the profits or the losses that you have made from January to December. Okay, so this depreciation, it occurred in the other period. Remember, when you are recording the T account, you learned that the balance carried down is same as the balance brought down, isn't it? Yeah, so this balance, the 31, this 30,000 is the same one that you closed with in the previous period, right? It means that you closed with this amount. So now you're opening with it. So since this occurred in the previous period, when you're dealing with the profit and loss account, we're just interested in the things that just occurred and the transactions that just occurred during the period under concern, which is from January
Clear,
1.
sir.
Yeah, you've got it. Thank you.
Yes, thank you.
Progress. So I was saying that the allowance for receivables is just a 5% of the receivables. So you can get 5% of the receivables. 5%, which is 0.05. If you're finding pressure on how to find 0.05, you can say 5 divided by 100. That should give you 0.05. Fine. Times multiplied by what? By the receivables. Your receivables are 60,000. So you multiply that by 60,000. That should give you how much? How much is that?
3,000.
3,000. Okay. This was the allowance for receivables. Now pay attention. This was the allowance for receivables that you have. Okay. This is the allowance for receivables that you just what? You have as at what? As at 31st. As at 31st what? December. Now what you do, you to this amount, you subtract this accumulated allowance for receivable, the one that you brought from the previous period. Where is it? This one. Allowance for receivable that you started with. I'll repeat here so that they can hear. That's how I repeat. The third is saying that you can, after finding this accumulated depreciation or allowance for receivables or provision for bad debt, those are same things, right? When if you start finding provision for bad debt, it's the same thing tomorrow. Please don't just start finding disturbing yourself. So you will subtract this allowance for receivable that you opened with when you're opening the financial year, the 4,000. So you say 3,000 minus what? 4,000, and you listen attentively. You have a negative what? 1,000. Okay? You have this negative 1,000, right? So far, so good.
No, sir, I lost you. Sorry, I was kicked out. Just joined. I just joined the 3,000. You said, yeah.
Okay.
We calculate
When
the
you
4,000 with what?
Listen, when you get this 3,000, from this 3,000, you subtract this allowance for receivable that you came with from the previous period. This one, allowance for receivables 1 January. You know that all these records are for 1 January. These were the balance brought down from the period, from the previous period. Okay, so you subtract this, and what you get is a negative what? Negative 1,000, right? You found a negative balance. Sometimes you can find a positive answer. Now, this is what it means. If you find a negative answer, it means the allowance for receivables or the doubt on debtors reduced. If you find a negative number, it means that the provision for doubtful debt reduced, or the allowance for receivables reduced. So since the allowance for receivables reduced, this is an income. You add this 1,000 to the what? To the other incomes. Remember, when you're doing the profit and loss account, when you reach after, you will see after gross profit, right? To gross profit, you add the other incomes. Now you add this 1,000 as a reduction in the what? Reduction in the allowance for receivables. Is that clear? It's a gain. It is the other income. Once the doubtful for the provision for doubtful debt reduces or the allowance for receivables, it means that it's a gain to you. You record that under other incomes. Is that clear? You will not record the negative 1,000, no. You will record it as a positive value. It's an addition, so you add it. Clear?
Yes, sir. So it's
Yes,
like
sir.
you were given a provision of 4,000 for the year. Then you have only used 3,000, not so?
Yes, sir.
Okay.
Yeah. So you have just used that. So you have this gain, okay? It's a gain to you. So that's how you record. But if you find this answer is positive, it means that this one it is an increase, okay? A positive means an increase. It means that the doubtful debt, allowance for doubtful debt increased. It increased by 1,000. This increase will be recorded under expenses as an increase in doubtful debts. Is that clear? If you find this answer being positive, you record under expenses as increase in doubtful debt or increase in allowance for receivables. Since now you have allowance for receivables, you say increase in allowance for receivables 1,000. It's an expense. Have you seen the way how this is treated? If it's a negative, it's a gain. If it's a positive, then it's a loss, like it's an expense. Is that clear? Hello.
Yes, sir.
I call for questions from anyone. Anyone is at liberty to ask questions.
Me, sir.
Yes, sir.
Yes, sir.
Gift here. So I want you to shed more light on the inventories. If you scroll down, what did you do to it? I think I missed it.
Which inventory is this, sir?
On the adjustments.
Oh, for the inventory. Okay, yes. Thank you. This is a closing what? Inventory as at 1st December. It's a closing inventory. You will see it like you record it where you record the closing stock, right? It's a closing stock. I'll show you the format like very soon. That's where we are going. So just know it that this one is a closing what? It's a closing inventory. Remember the profit and loss account has a format, right? There is that format that I gave you in the previous studies. So under closing inventory, you write this amount. Clear?
Yes, sir. Thank you.
Okay, you're welcome. And now we proceed if there is no question from anyone.
Excuse me, sir.
Yes, madam.
Excuse me.
Yes.
I have a question.
Yes, madam.
So when calculating the allowance for receivables, the one on adjustments and the one in the trial balance, you start with the one on the adjustments because maybe some of us might make a mistake of subtracting this 3,000 from the 4,000 and we get a positive number.
Oh, okay, yeah.
May you please shed more light on that, on which one to start with?
The explanation is that when you calculate this 3,000 that you've gotten from this, that is the amount that you used. Like that's the allowance for receivables, like that you used in that period. Then you will subtract the provision that you had been given, which is a 4,000 in the trial balance. Okay, you subtract it from what is in the trial balance, a 4,000. Always like that. You got it? If you say 4,000 minus that, you get a positive value. Then you will end up treating it as an expense, and you find that even your balance sheet will not balance. You know what it means. Happy now?
Yes, sir.
Okay. Is there any question on discussion of the question? Because if you understand this one, the next examples, We'll not even need to solve or too much, say a lot. We'll be just adding few things. Like we're just building on top of this in the next examples. Is that clear?
I have a question.
Yes, madam.
What exactly is allowance for receivables and why does it appear in both the profit and loss and the balance sheet?
Okay, thank you. Anyone need to answer to help me? I think I explained behavior on that one. Anyone? What is the allowance for receivables?
Is it the one you said it's a bad debt?
It's same as the provision for bad debt. It's not same as bad debt. Bad debt is not same as the allowance for receivables or provision for bad debt. No. Okay. So what happens is that when you're recording, okay, as accountants, you are recording the amount that you have from your debtors, how much your debtors owe you, right? Those people who owe you, you call them the debtors, or sometimes you call them as the allowance for as accounts receivables, right? From the receivables, that's how much you have from the people you expect. Now, sometimes when you look at the people who owe you, you look at them, you're like, these guys, there are some people that you doubt, okay? There's some people that you doubt, you're like, but this one, if they will pay, otherwise, So what you do now, let's say you are expecting a 12,000 from the what? From your debtors, right? Then there is someone whom you doubt, you think maybe this person will not pay, maybe that person has a 2,000, all right? Which means that since you have got that allowance, that provision, you are going to just record what? You're just going to record a 10,000. You will not record this 2,000 because you are not really sure, like there's a lot of doubt. Okay, so you are not sure about this. So when you're recording, you just record this where at least there is a little bit of certainty. Though, okay, where there is higher probability of receiving. Yeah, you will not add this. Okay, now what increase and reduction in allowance for receivable means is that this same person you were doubting, okay, the person you were doubting that they won't give you a 2,000, maybe you are doubting them based on the grounds that maybe they are not employed. Then you hear that tomorrow they have gotten employed, and you know, okay, there is some reduction in your what, in your doubts. Okay, you're like, maybe they will manage to do what, to pay. Let's say maybe they will, at least maybe 1,000 they will manage. Okay, so instead of recording what, a 10,000, now you end up recording what, 11,000. You will add this. This is what I meant when I said that the reduction in allowance for receivables is added, because it's like your doubt has reduced now. So when you go to receivables, it will affect the receivables, which are fixed assets, right? Are current assets. Receivables or debtors are current assets. So your current assets have done that. But what if this amount, this 2,000 has increased, whereby maybe there is the other one again, among those whom you trusted, you had written 10,000, right? Among those people who would make this 10,000, there is the other one again, who is showing that they cannot give you maybe 1,000. It means that this 3,000, this 2,000 will increase to what? To 3,000.
To 3.
When you are recording, you will just record what? 9,000 from 12,000. You just record 9,000 because you're not sure about this. You subtract this. Now, these adjustments are made in where? In the balance sheet. Remember, that's where you have all current assets. The debtors, the account receivables go in the balance sheet. You understand, right? So when you subtract like that, it means that your amount has what? Has decreased. That's why you treat the increase as an expense. Clear? I don't know if that
Can I
helps.
just get more clarity? I've understood you, but I want to be sure if I've understood correctly. So what you're saying is when we have debtors, which are they are receivables. When there's a certain amount that we are not sure we'll receive, that's what we call the allowance for receivables. In this case,
Yes.
the either a 2,000 or a 3,000.
Yeah. Exactly. Just that
Thank
amount that we are not sure.
Thank you very much, sir.
You're welcome. Then sometimes now there is that time when this amount has not been paid. That's when it becomes the bad debt. This is when it becomes a bad debt. You have reached the 31st December. You need to close this financial year, right? Then there are some people who have not yet given you the money, and you're closing the what? The financial year. Okay, you're closing the financial year. You're closing the books. So those people now, these guys, you regard them as what? As bad debts. A bad debt, it means it has occurred, like these guys have failed to pay you. But allowance for receivables is just a doubt. So you're not really sure. You're just doubting. It is possible they can pay you. Those same people you were doubting. Do you get that?
Yes, sir. Thank you so much.
Okay, but sir, you have explained, we have heard. Is that clear?
Clear, sir.
Okay, but sir, you can move to the next slide and show us the solution. So now, this is what I was saying when you need to make a record. This is the income statement, or which you call the profit and loss account, right? This is your income statement. This is how it goes. Since we have already discussed, you start with the sales, right? You know the sales, that amount for sales that we had in the previous. Opening inventory, that inventory for 1 January, right? It's called the opening inventory. The inventory for 1 January, this one, that's the opening inventory, right? You started with this one. You record that as the opening inventory. This is just a simple format. Okay, the opening inventory. From the opening inventory, listen now. This is what you do. From the sales, sometimes you have what you call sales return or returns inward. It's the same thing. Returns inward. Okay. You will subtract from the sales return or returns inward. It's the same thing. That's why I'm using this word. In case you find one of them. So you are used. Returns inward or sales return is the same thing. It means that you've made sales, but those people have returned the things to you. They have said, earn your things, guys. You get it, right? Hello.
Yes, sir.
Yes, sir.
Yes. So you say sales minus the returns inward. That is the amount you record here as the net sales now. It will not be sales, it will be called net sales. Net sales simply means sales minus the sales inward, returns inward. Then from there you minus it, you reduce the cost of what? Good. Under the cost of good, that's why you have opening inventory. From the opening inventory, you add the purchases. Those entries are there in the trial balance. You add the purchases. From the purchases, listen, from the purchases, you subtract the returns outward. If you have the money, returns outward. By the way, returns outward is same as the purchases return. Okay? Purchases return. You will subtract that if you have them. Remember, the profit and loss account or the income
Sorry, sir, you are
statement is written
seriously
according.
breaking. I don't know if it's only me.
Oh, am I breaking?
You are
Everyone?
very clear, sir.
You are
I
very
think it's just
clear.
our network. Madam, you can work on your network. I think our
Okay.
network here is very powerful. We have a very powerful network here. And we are proud
Okay,
of
let
it.
me, okay, thanks.
Okay, that was commercial break. Now, So returns what? Outward is same as purchases return. So you subtract that from the what? From the purchases. That is if you have it on the trial balance. Remember, a trial balance is just written according to how much information you have in it. From your example, that this question we had, it never had the returns what? Outward. It never had the purchases return, where you purchase things and then you return them. Okay, we never had such a scenario. That's why we didn't subtract. So if you have it, you subtract. Then from there, again, the other element that I should be able to add here, and of which these things are there in the recordings that I gave. The carriage inward. Carriage inward. Carriage inward should be added immediately afterward, after purchases return. Why? You need to add carriage inward in this trading account. So if you have it, you add carriage inward. Carriage inward is added here. You have heard that. The reason why we are not recording is because we don't have it. We never had it in that trial balance. I mean, in case you have it, it is to be added. Then from the calculation that we had, you remove what? This will be the entire cost of goods. Then you remove the closing inventory. That closing inventory, that one who had asked the question, the inventory has 31st December. Yes, sir. Yes, sir.
You're too fast. So you mean the inward is treated as an expense for transporting goods?
Carriage inward, yes, sir. It's not an expense, it's added. Carriage inward is added.
In the actual sense. In the actual sense, you use it as let's say when you want to transport the same goods, when you use transport. Is it that example you can use?
Yeah, like the cost that you incur when you're bringing the things inside, that's carriage inward. Okay, things that are offloading cost, all those things, right? We call that as carriage inward. It is added here. We'll have another example. We'll have another example, but you can just maybe hold some fire. There's another example where it is recorded under the trial balance so that you can even see it clear. Okay, I'm just mentioning it in advance so that when you reach to that example, it can be something not very strange. You got that?
Yeah.
Hello. Okay. Oh, I'm becoming too fast. Okay, Wasad, slow down. People are saying don't slow down. All right, thank you. So now, it's better we are slow. We do whatever we can manage to do within the limited time. Cost of goods. We will have this entire cost of good. It should be subtracted from the sales to give you the gross profit. What we will have now is a gross what? The gross profit. Gross profit simply means sales minus what? Cost of goods. Or net sales minus cost of what? Cost of good. It's the same. Why net sales? Net sales comes in when you have the sales return, or returns inward. That's when you have the net sales. But if you don't have them, just use sales. Is that clear?
Yes, sir.
Okay. Then to the gross profit, you add now other incomes, okay? Other incomes. Things such as the discount received, okay? I think you saw the discount received in the, not you think they saw, sir. You can show them so that they can see that it is. This discount received here. You've seen it, right? 60,000. That's a discount received, right? It is the other income you add it. Discount received is added as what? As other income. Clear? You add discount received. Then the other thing that you add to the other incomes is what? The reduction in allowance for receivables. I'm sure now you understand this. What we mean by reduction in allowance for receivables, this 1,000, where it comes from. The reduction in allowance for receivables, it just simply means that there was a reduction, the allowance for receivables reduced, and you had this 1,000, okay? This 1,000. Is that clear?
Yes.
Yes,
Yeah.
sir.
Yeah. Then from there, what we have now is total what? Total income. Remember this 7,000 is being added to the gross profit, so that we can have 283,000. 283,000 as the total income. From the total income, you will subtract all the expenses. And the following are the expenses. Number one, advertising is an expense. We saw it, 16,000. Bank interest is an expense. Carriage outward, those who are asking questions, where the position of carriage outward, I said is an expense. Then now check computing expenses. We said computing expenses have adjustments, right? They have adjustments. You add what? You add
Sir,
that
just a
accrue.
minute.
Yes, madam.
Sir, you said carriage inwards is what? Since carriage outward is an expense, inward, then it's what?
Carriage inward is added under the, is added here. It's not an expense. It's added here under the cost of good. It's a cost of good. It directly, these are direct costs, like they directly affect the good.
Okay.
Okay. All right.
Okay, sir.
So the computing expenses, remember they had an accrual of that 1,000 where that guy had not yet received the invoice, isn't it? That computing expense, that's why you have 21,000. Then the power had an accrual as well, right? There was an accrual for power for 2,000. Then there was a prepayment for rent. You remember that we had a prepayment for rent, right? According to the adjustments that we made. You heard that? There was this prepayment for rent, right? So rent was paid in advance. That's what prepayment for rent is. So that's why you subtract this. Our total rent is here 12,000. So you subtract. Did you get that? Hello.
Yes, sir. Yes, sir.
Salaries, you know them. Depreciation for fixtures, we just record that one which occurred in the period. I said the depreciation that you're interested in is that one which occurred from 1st January to December 31st. And then these are total expenses. They add up
No,
to.
sir.
You are saying no.
Need to go stripping.
Yes, madam. What is your question? Hello, do you have a question?
Sorry, so maybe just to take you backwards.
Yes, madam.
On the bank interest, maybe just try to explain for me a bit why the bank interest is under expenses.
Anyone to explain to us what bank interest is and why it is an expense? Quickly, I think, is it yesterday I was, on Friday, I was talking about the bank interest thing again. We talked about it. What is a bank interest and why is it an expense? Anyone to quickly help me?
Gained on a loan that's been gotten from the bank. Therefore, it's an expense.
Okay. What about others? What are the bank interests? What are the interest charges? Those charges. Okay. What are they?
Yeah, those are extra charges the bank charges us for the service that we do, of course, with the loan interest and other like checkbooks and all those. So to us, it will come as an expense.
Okay. So to you, yes, to us as a business, it will become as an expense. Does that help the questionnaire?
Yes, it does. Thank you.
Okay, great. So when you sum all these expenses, they add up to 185,000 as the total expenses. That should be subtracted from what? From the total income, so that you can have the net profit. Is that clear? Hello?
Yes, sir.
You are subtracting like this 283,000 minus 185,000. What is 185,000? 185, it means total expenses, right? And you have 98. Now, this 98 can either be a negative or a positive value, okay? Listen, if it is negative, you don't write net profit. That is not a profit. You write net loss, right? It's a loss. If this figure is negative, it means it's a loss. You made a loss. Remember, this is just profit or loss. So it can either be a profit or a loss, right? You've gotten that. It doesn't just add up where you have a negative value here, then you start writing at net profit. What kind of profit is that, right? You got that?
Yes.
Okay.
So
Progress.
I've seen
Yes,
others in the accounting practice, they write negative figures as profit. Then when it is positive, it's a loss. Any comment on that?
like a negative figure is a profit.
Yes. Like they write the figures with negatives. And when it's negative, it means it's a profit. When it's on the positive, it's a loss.
Okay. On the same financial statements like this.
Not really this one, but
Oh, okay. Okay, I've gotten. Anyway, the world of finance is so broad. Maybe let me just make a comment on that. The world of finance is really broad, as you're going to do when you do financial statement analysis, like as a course in somewhere fourth year. There are a lot of things that you consider. Some of you also do derivatives. You will also do portfolio management, things such as portfolio management and wealth planning, wealth creation, among others. But the thing is that when you're talking about the financial statement like this, like straightforward, what it means to have a negative, it means that these expenses are more than what? Are more than income. And obviously that cannot be profit. Is that clear? Let's put it to this context. We'll be revealing other things later on. Thank you very much. Clear? Yes, sir.
Yes, sir.
If that is clear, now we can quickly go to the balance sheet. Now the balance sheet is very, very straightforward, as you may know it already. Here is your balance sheet. It starts with the fixed assets, okay? You start with the fixed asset. Now, check the fixed assets that we have. We had the fixtures. The fixed assets, you subtract the depreciation, okay? Now, the depreciation that you subtract here on the fixtures is the depreciation from the time the fixtures were bought up to now. That's why you have to add this 30,000, the depreciation that occurred from 1st January up to 31st December, plus that other depreciation, the accumulated depreciation. They are not seeing it. You have to show them. The SAR is saying there is this depreciation on fixtures that you brought from the other period. You add it to this other depreciation which occurred in this period, so that you can have what? 30 plus 30,000, and you have 60,000 as total depreciation now. So depreciation has been increased to 60,000. Did you get that?
Yes, sir.
Like a total. Okay. And so If you have heard, this is what happens. So you subtract this 60,000 from this 120, you have this 60 pin. 120 minus 60,000, you have that as total fixtures. Then we never had the other fixed assets. We can still have other fixed assets, such as buildings, okay? Buildings, the premises, land, all those things, right, should be added under fixed assets. To the fixed assets, you will have these current assets, okay? You have these current assets. These are current assets, okay? Inventory is a current asset. Now, receivables, check. From the receivables, you remove the allowance for receivable. That doubt, remember that one I had asked about allowance for receivables in the balance sheet. That 3,000 you had calculated from allowance for receivables, should you remove it, okay? And you just recorded 57 now instead of 60. Why? Because you were doubtful about the 3,000. You're not sure that people are going to pay you back. Clear?
Yes, I see.
Sir, excuse me.
Yes, madam.
Which which inventories do you consider in the balance sheet? Is it the opening or the closing inventory?
Oh, okay. Okay. Great. Which inventories are we interested in? This 40,000, is it an opening inventory or a closing inventory? Someone is asking. It is a closing what? It's a closing inventory. That is the inventory of that period, not the opening one. The one that you opened with is from the previous period, madam. You got that?
Yes.
Okay. Don't worry, you'll be fine. Then you have rent prepaid is an asset. A prepayment is an asset. The bank is also a current asset, this one, the money that you have in the bank. Then the other thing that I should record, you could also have things like goodwill, okay? Those are assets, we call them intangible assets. Good reputation, goodwill. Yeah, you have heard that. So those are assets, all the current assets are recorded here. When you have summed, this is the total for current assets, okay? This is the total for current assets. Then from the total for current assets, let me just underscore that it just depends on the format that you want to use. Yeah, for the balance sheet has got two formats. So you can follow this one that I am presenting. Then I can also show you the other one. So with this one, once you add the current assets here, you have this amount. You will less from this sum, from this 105. You just have to less the current assets, the current liabilities. Payables are current liabilities. Accrues for power plus accrues for computing expenses. All those should be subtracted from this 105. And what you remain in this as the net asset is 60 what? 62,000. That should be added to the fixed assets, so that you can have the net assets equal to 122,000. Clear? Hello.
Yes, sir. It's clear.
Clear, sir.
No, sir,
Clear,
just
sir.
come again a bit, sir.
Oh, we come again a bit. When you sum the current assets, you have this total. From that sum of the total of current assets, you will remove the current liabilities, all current liabilities from that sum. This amount that you're going to get, it is this amount, you add it to the what? To the fixed assets, to that total sum for fixed assets, so that you can have the net what? The net asset. Do you get that?
All right, sir.
Okay. Remember now, the equation that we are following, the accounting equation that we are following is assets minus liabilities is equal to what? To equity, right? Which we call capital. We have done, this is called net asset. Asset minus liability. You have the net asset. So check now, the other part. We need the part which has got the capital. You can say financed by capital, that capital you have in the question, plus additional capital. Then you also add the what? The net profit. You have 148,000. From here, you should subtract the what? The drawings. Those drawings, we had said the drawings, they go in the balance sheet. Once you do all that, all you remain with is 82,000. From the 82,000, you will add the long-term liabilities. A bank loan, we had a bank loan, it's a long-term liability. You add to that, that gives you capital employed as 122,000. So that we can obey the equation that says assets minus liability is equal to what? To capital employed. Is that clear? It's same thing. Asset minus liability, or asset is equal to capital plus liability. This is another format of the equation. But I was just commenting on this one, asset minus liability. This is the one that we are following. It is for that equation. It's the same equation, you know, that it just carries these different forms. The other form of this equation is this one, where I say asset should be equal to what? Current plus liability. I think this one should be more straightforward. Where you add all the assets, current assets plus fixed assets. You just add the fixed assets, all the fixed assets, right? Plus the current assets. You can add them where the current assets ending. They end here. Can you add them? How much are they? We are adding, we want to follow that format which says assets is equal to capital plus liability. How much is that?
That 105.
Sorry?
It's 165.
165. Okay, you have 165,000. It should be equal to, let's get capital. On total capital, when we have got this, right? We have got 82,000 on total capital plus the liability. Liabilities that we have the current liabilities and the what? And the long-term liabilities. Remember that. Okay. For current liabilities, we have which ones? How much are they? It's 62, right? Like when you have these. Is it 62? No, it's not 62. The current liabilities are here. Like add this plus the long-term loan. Those are current. Those are liabilities, not current. Current plus fixed long-term liabilities. Just add all the liabilities in short. What do we have? This is 43. It's 43,000 plus 40,000. Should be 83, right? Is it? Should be 83.
Yes, it's 83,000.
Can you add now 83,000 plus 83,000? How much is that?
Sorry, so did you say 82 plus 83 or 83 plus 83?
82,000 plus 83,000.
Okay, so it's giving us 165.
165,000. Have you seen that this equation as well holds, right? They still hold all the equations. All the equations hold. With that one, you just add the fixed assets, all of them, you list them. Then you also add the current assets, just current assets. You have one figure, just as total assets. You record here where there is the net asset, you record total assets. Then you come to what? To capital. How you come up with capital? Say capital plus capital employed plus net profit, right? Then you less what? Drawings. That is your capital. Then you add what? What do we add? We add the liabilities now. This is capital. Plus all liabilities here. Current liabilities plus long-term liabilities. Just add them together, then it balances. This one is very straightforward. Any question? Any question? Any question from anyone?
Yes, sir.
There is no. Yes, sir.
So when you reach 122,000, the net asset, what I did is I removed the long-term loan, and then it gave me 82,000.
Okay.
As a net asset. I added the 10,000 plus the net profit of 98,000 to give me 10.
Sorry, sir. Where are you commenting on? I'm not. I'm not sure following. I'm lost.
108.
Which part are you commenting on?
So this 140. I lost. Okay, yeah. What I did, I just came collect until up to 122. Then immediately after 122, I subtracted the long-term loan, which is 40,000.
Okay.
Gave me a net asset of 82,000. So then I came to the other side, the finance capital.
Oh, okay. The finance capital as well, it gave you 82,000.
So capital introduced 40,000. I added the 10,000 and 98,000. So the total, it gave me 148,000. Then I subtracted the drawing of 6,000 to give me 82,000. So I don't know.
Okay.
I thought it has balanced.
Oh,
I don't know where I was
interesting.
wrong.
It has balanced according to the way how you have really given it. But anyway,
Yes.
I'm not sure. I'm not sure about that one. I'm not sure if I would recommend that you go with it or not, because what you are trying to follow is the accounting equation, right?
Yes.
Your accounting equation, which says the assets minus liabilities is equal to capital, or assets should be equal to capital plus what? Plus liabilities. So these two formats that I've given you, they are obeying this equation. So I haven't figured it out on how or what you have said obeys the equation. Yeah, so I haven't yet figured it out. But if I figure it out, then it can still be, yeah, I don't know the form that you are taking. Yeah.
Okay.
All right, thank you.
Okay.
Clear? Are we all fine with this? Okay, now. Then we can do the other example where we will not do much of writing as well. We will be fast on it. I know you are tired. You are almost tired, but you will not be tired because we still have bank reconciliation to do. So I know bank reconciliation is straightforward than this. This had a lot of explanation. Let me show you this one. I'll show you this one again. We are just discussing it. Okay, no, it's the same. Where is it? Okay. Let me show you this one now. let's just discuss this one. I think with the formats, since we are okay, we can just discuss, right? Without writing. Can just discuss. Let's discuss this one for 2020. As well, you see, now with these are straightforward. They are too straightforward. Okay, quickly fast forward. Let's talk about what? Where do you put sales? As usual, you start with where you locate this, the location of this. The sales, they go in the PL, right? Profit and loss account. What about purchases?
Profit and loss account as well.
Profit and loss account. Don't worry, there will be some break. Yeah, let's do this one. Then we'll give some break. Please, can you just endure this a bit? Discount received.
Profit and loss.
It's the other income. Yes, it's the other income. Profit and loss. Inventory, opening inventory. In the profit and loss.
Profit and loss.
Carriage outward.
Profit and loss as well.
It's an expense, this one. Carriage inward, profit and loss is a cost. And returns inward, this one is good. Returns inward, it's still profit and loss, right?
Profit and loss. Yes.
That's the one that you subtract from the sales. Then it returns outward, it's an expense, this one. It goes in the profit and loss account, right? Wages and salaries, they go under profit and loss account. Motor expenses, rent, sundry expenses. Motor vehicles. Motor vehicles, this one is an asset, right?
Yes.
Going in the balance sheet. Fixtures and fittings in the balance sheet. Receivables in the balance sheet. Payables in the balance sheet. Cash is a current asset in the balance sheet. Cash in hand, cash at bank. The drawings in the balance sheet. Capital in the balance sheet. Clear?
Yes, sir.
Are we all fine with the allocation? Like, are we fine with the allocation?
Yes, sir.
Yes, sir.
If we are, then we can go to the simple adjustments that are here. Just the 3 adjustments. Closing inventory. Oh, this one was so. You've seen that the UNZA exams are too straightforward. Sometimes, look at, they even mentioned closing inventory. It's here down. Depreciation to be charged at the rate of 10% on costs, fixtures, and fittings, and 25% on cost motor vehicles. Okay, just here now. What does it mean when you say depreciation is charged on costs? Is it a straight line or reducing balance? The charge on costs.
A straight line.
Hello, it's a straight line, aye? The charge on cost is a straight line. So it means that depreciation, so tomorrow, like when you find the straight on cost, don't start looking for straight line or what. You have heard that. So it's 10% of fixture fittings. Fixture fittings is 60,000. So what is the depreciation? 10% of this, 0.10. What is 10% of fixture and fittings? Hello?
6,000.
60,000. Then what about?
6,000.
Okay. 6,000. Then we go to
Motor vehicle.
fitting. Motor vehicles as well is 25%. So just do 0.025. Okay. So this is the depreciation for fixtures and fittings. Aye. What about for motor vehicles? 25% of motor vehicles.
100.
Where are motor vehicles? Oh, they are here. They are motor vehicles. 25 of 100, 400. Right? It's what?
25,100.
25,100. Eh? 25,100. Like this.
Yes.
Yeah. So this is the what? The depreciation on what? On motor vehicles. Is that clear? Using a straight line method. Somebody had asked me, Wasa, what about using what is that? Reducing balance method. Okay. What about using reducing balance method? Now, with this question, since you are not given the accumulated depreciation, you cannot use the reducing balance method. The reducing balance method is that you are just having this percent that you have, percentage times the net book value, okay, times the net book value. Hi. Okay. It should be, but I doubt. Okay. So, but I'll show you for the reducing balance. I'm showing you for fixtures now. Is that clear for straight line?
Come again.
Like, are we fine on how to record using straight line method? Just take this 10%. If you don't know how to do 10%, just take 10 divided by 100, which is 0.19. 0 times the cost on fixtures. It is what? 60,000. That gives you 60,000. This is the depreciation. Remember, depreciation is an expense, right? This is the depreciation that occurred in this period as an expense on fittings. Is that clear?
Yes, sir.
Is the questionnaire fine? Then for 25 as well, just do 0.25. How do we get 0.25? You say 25 divided by 100 times the motor vehicles at cost. The motor vehicles were bought at what? At that much. So we had the 25,100 kwacha. This is the depreciation on what? On motor vehicles. Is that clear?
Yes,
hello.
sir.
Okay. Having said that, then you can go to bad debt. The bad debt, you know, the bad debt written off should be subtracted. It's an expense, this one. In the profit and loss account should be recorded as what? Remember, this is not provision for bad debt. It's a bad debt. It's an expense. So record it under expenses as what? As an expense. Then there are no further adjustments. You're done. Just 3 adjustments. Okay? Just 3 adjustments. Then you prepare the what? The trading profit and loss account, and then the balance sheet. Are we all fine with this? Then I show you how to do reducing balance methods. Are we fine with this discussion? I show you the reducing balance method.
Yes, sir.
How to calculate. Okay. Showing you how to do the reducing balance method. The question where you can have reducing balance method is, it is not that one. It is this one. Don't be tired. We'll give you a break, please. People are starting logging out. You're tired of learning. It's better you understand in this class, then you'll be fine. You have no time to start studying, because if you don't understand now, you start struggling to understand in the video. Okay. Here is another question. Okay, about allocations yourself, you're already fine. Let me quickly go to the adjustments for provision for that date and how to calculate depreciation using reducing balance method. It's here. Okay. You listen attentively here because everything is just remaining the same. Everything remains the same, only these adjustments that we are making now for straight line, tan, otherwise everything is the same. So check now. When I want to do straight line, since you already know how to do straight line, 25% of this, you just do 0.25 times, you go on plant and machinery, how much it was bought, right? You have known that is to go on plant and machinery, you check the cost that is there. How much is plant and machinery? Is this high?
Yes,
So you
450.
just do, yes, you do 25% of that. Using straight line method is that straightforward. But let me show you how to do reducing balance. So with the reducing balance, you need the net book what? The net book value. Okay, you need the net book value. The net book value. How do you get the net book value? Hello? How do you get the net book value? Because we said it's the given percent. In this case, we are dealing with 25%. It's 25% of what? Of net book value. The net book value on plant and fixtures. What is the net book value of that?
Hello.
Yes, sir.
Hello, you can hear me?
Yes, sir, we can hear you.
Okay, so how we calculate the net book value is we get the, if it's for plant and machinery, since that's at cost, we subtract the accumulated depreciation from the plant machinery cost. So you subtract, yes, that's when you get the net book value.
Okay, thank you. Is that clear? So the net book value for plant and machinery, you get this cost, how much you bought it, which is 430. Listen, this is how you do reducing balance. This is how you bought it, minus the accumulated depreciation on the plant and machinery. It is given here, this amount. So you should subtract this 140, 145, 750. How much is that? How much is the net book value for plant and machinery? Friends, how much is it?
It's 284,250.
284,200 and what? And 50. This is the net book value. Then you do 25% of this, okay, which is 0.25 of this net book value. That is your depreciation using now, using what? Using reducing balance method. How much is it?
71,000.
Yes.
71,062.5.
71,062.5. Like this?
Yes.
Yes. So this is the depreciation on what? On plant and machinery using what? Reducing balance. If you are using a straight line method or you're calculating at cost, you could have just multiplied this 25% times this 430. where is the 430, which is the cost. I would have just multiplied by the cost, 430, and it would have been very straightforward. What does it give us on a straight line method? We compare, we just want to compare. How much does it give us? 430 times the 25% of 430. What is the 25% of 430?
$107,500.
107,500. You've seen, have you seen the difference? This is the same depreciation on this same asset using straight line. The up one, this one is using straight line. But this down one is using what? Depreciation. Is that clear?
Sir,
Yes.
sorry, I'm a bit behind. On the reducing balance, you subtracted 145, the accumulated depreciation from the
cost.
From the cost. Then
yes,
again, subtract 25% of that.
No, like when you subtract this accumulated depreciation from the cost, you get what is called the net book value. The net book value times that 25%. That is how you get the depreciation needed. You got it? Hello?
No. Explain a bit again.
I'm saying that from this 430, which is the cost, how much you bought the asset, minus the accumulated depreciation 145, which is how much you have what? How much the value it has lost in the from the previous period. It lost this much, right? It lost this much. Then whatever you remain with here and you subtract, that is your net book value. Your net book value times this percent, 0.25%. Then what you get is called the depreciation. Do you get that?
Yes, thank you.
Oh, okay, welcome. So similarly, you do the same thing to fixtures and fittings, right? 30 minus the cost for the depreciation for fixtures is that, right? So say 90,000 minus what? Minus which one? 17,125. The answer that you get is the net book value. Then you multiply by the percentage that you are given for the fixtures. Is it 10%? Should be 0.10. Then whatever you find, that is the depreciation that has occurred in the new period. For what? For fixtures. And you record that in the profit and loss account as depreciation for fixtures. Do you get that? You just need to understand that everything remains the same. What just changes is now the method of depreciating. So if you know how to deal with all the two different methods of depreciation, then you're good to go. Everything will just remain the same. Is that clear from everyone? Do I have a question from anyone else? Anyone? You do the same for motor vehicles as well. It's the same thing. If you're using straight depreciation, reducing balance method, depreciation, you can do the same as well. The cost for motor vehicles is this one, 180 minus this, that is your NBV, your net book value, times what? 0.25, the percent that you're given, okay? It's not always 0.5, you take the percentage that you're given. You do this if they specify that you're using reducing what? Balance method. But if they say that you're calculating on costs or using straight line method, you just multiply direct. This percent times this cost, the cost of that asset. Clear? Hello?
Clear, sir.
Yes, sir. Can hear you. It's clear.
Okay. So otherwise, everything just remains the same. There is nothing much. The adjustments are still the same. Yeah. The adjustments made usually are just still the same. So do I call for question this time around before we can give you a break so that we can pass a comment on the bank reconciliation? We need to start with the third question that you had in your previous assignment. That's when we can start from. Then we can end with the other person. So do I have a question before we give you a break? Hello.
Excuse me, sir.
Yes, madam.
There's a previous question we had before this one. This one I'm seeing on the screen.
Yes.
May I see that? There's something I want to just confirm.
Oh, okay. Okay.
The one which has returns inwards, returns outwards in carriage.
Yeah. This one. What do you want to confirm, madam?
Yes, I want to confirm what you said. You said carriage outwards is an expense?
Yes, carriage outward, not returns outward. Carriage.
No, I'm
out.
talking about carriage for now.
Yes. So carriage outward
Yes,
is an expense.
then carriage
inward.
inwards is supposed to be subtracted from the cost of
Yes, it's a cost of goods.
goods.
It's a cost of goods. It's added among the cost of goods.
Okay, then returns inwards is supposed to be subtracted from the sales?
Yeah.
No, returns outwards or return inwards?
Returns outward is subtracted from the purchases.
From the purchases, then returns.
Returns inward is subtracted from sales. Returns inward simply means sales return. Like they have brought back the thing.
Then outwards is supposed to be subtracted from the purchases.
From the purchases, yes. You have bought some purchases, then you have returned.
Okay.
Okay. Any other question from anyone? Okay. We can have a 3 minutes break. I think 3 minutes is enough so that we move to bank reconciliation statement. Yeah, 3 minutes is enough. It doesn't mean you log out, madam.
One more thing.
Yes.
When we have capital introduced, where do we use it?
Under capital, you add it to capital, like where there is capital there in the balance sheet.
Balance
right? There's
sheet.
that position. Yes, where you put capital, then down there you add that capital introduced.
Okay.
Okay. Then we can have a short break, right? Let's just have a very short break for 3 minutes. I think is enough. You don't log out. What you do, you remain in the class. This is open now for any kind of discussion. For 3 minutes, we can greet each other. We can say whatever we want to say. Then after 3 minutes, I'll come in and start presenting something very different.